Hi, Jessica Genung here with Active Realty, and today I am here with my lender, Dale Walker, who's with CMG Financial, and we're doing something a little bit different today. We are going to be talking about some of the lending challenges that I'm having in my current transactions. Not when Dale is the lender, of course, but other lenders, and especially new construction, we're having a lot of challenges. So we're going to talk about what is going on and what can we do that if you are thinking about getting a loan, a mortgage right now, what can you do to have a successful process? So here we go. Thank you so much for joining me, Dale.
Yeah, glad to be here. Thanks for inviting me.
Yeah, definitely. I know the first thing that we had talked about is the lender capacity. Is that the main reason that you think that we're having a lot of these closing delays and things like that?
I think it's a big part of it. Kind of the backdrop behind that is that coming out of the first shock of COVID, financial markets just kind of went topsy-turvy for about 3 weeks. And then as things began to settle out, interest rates dropped, and they dropped to historic lows, which fueled another refi boom. And traditionally, when refis increase, volume goes up. That puts strain on lender systems for processing, underwriting, funding, and closing. Mm-hmm. Well, as that drains capacity, and then you've got purchase loans that have to close in a certain time frame because they are contractually obligated to do that, that begins to make it difficult for lenders to serve the needs of both the refi clients and their purchase clients. Now, I'm blessed in being at CMG because we are primarily purchase. That doesn't mean we don't do refinance, but primarily our focus is purchase to serve the needs of our realtor partners and our buyers. But when refis expand like they have since April of last year, and particularly the big push through the summer when rates dropped again, you've got capacity issues where lenders just don't have room to put all these loans in the system. So something has to give, and what typically gives is turn times. Things get stretched. And one of the ways that can be dealt with is hiring new staff, but staff takes training. And so you get this cycle going where as capacity increases, turn times decrease.
Okay. That absolutely makes sense. And I'll just kind of share with you a little bit about my experience on some of the current transactions that have been happening with other lenders is that everything starts out great. It's kind of like the honeymoon period with the mortgage originator. And for whatever reason, once it's passed to the processor, that is where we're starting to see the delays and kind of the breakdowns in communications. Oftentimes they're asking for the same documents that they've already had. There just seems to be a lot of disorganization.
Yeah, that could be a couple things. Remember that a loan officer has their clients, but the processor has all the clients from many loan officers. So it's an exponential increase in the processor's job to manage all those files. And what happens is, just as on the larger scale, the lender is stretched to beyond capacity, so the processor is stretched to beyond capacity. And then you have cases where they just can't handle all the volume. So things fall between the cracks. The other thing that might be in play there is kind of depends too on how carefully the loan officer has prepared the file before it's handed off to the processor. Because remember, up until the point that the processor has the file, the loan officer is the one who's doing the interaction with the client. And so when that file gets handed off, if the information and all the details about the interaction that's taken place between the loan officer and the borrower are noted in that file, the processor should have everything they need to then continue the process as it was started by the loan officer. But if that processor doesn't get the information that they need from the loan officer, and they basically have to start over from scratch and try to figure out what's going on in this file, that's where things can get a little bit bumpy because there wasn't a good handoff from the loan officer to the processor.
Right. That makes a ton of sense. And that's one of the things that I love that you do is the consultation with the buyer. I feel like you are very thorough in the beginning and you seem to anticipate problems before they become problems. So how do we avoid, these issues? How do you choose a great, mortgage professional so that we don't have these issues that we're encountering?
Well, I would say first and foremost, you have to assume that the buyer's realtor, in this case, you're working with certain buyers that you and I work with together. The buyer needs to listen to the real estate agent that they're working with, because my assumption is that good realtors have relationships with good lenders who know how to avoid the kind of delays that you're talking about. Now, I realize that some buyers come already with lenders in tow. It might be, my brother has had this lender and it was great, or my cousin is a lender or whatever. So in some cases, that's a little bit difficult because you're trying to avoid stepping on toes. But first and foremost, I would say buyers, listen to your realtors, follow their advice for recommendations, because they have those relationships that are proven over time that work well. I think another thing to watch out for is not to throw the industry under the bus, but one of the things that I think the mortgage industry has done that is a disservice to consumers is they reduce the conversation about the mortgage to rate and fee. And I think the problem with that is, especially on a purchase transaction, it is so much more than that. It's about being able to get the loan done. It's about good communication between the loan officer and the client, loan officer and the escrow company, loan officer and the processor, loan officer and the underwriter, loan officer and the realtors. Choose somebody who will get the job done for you, who's good at communicating. And again, go back to your realtor. Are they suggesting you work with somebody, or are you thinking, you know what, I saw this ad on the radio or the TV. I'm going to go with these guys because they can give me the lowest rate. Problem is, there's different models out there. The business models that I've found to be most effective in the lenders that I've worked at are business models that really focus on client service, realtor service, doing a good job for our realtor partners, and making sure that the loans get done on time. Interest rate, fees, yes, those are important, but performing to the deadlines and milestones that the contract requires is really important too.
Well, I was kind of immediately going to a couple transactions this year that have been particularly difficult, or really over my career, quite frankly. And, why is it that you think that the big banks and like the credit unions in particular seem to be having the difficulty? Like, I don't know. So many of I don't want to throw any institutions under the bus, but, a lot of these big banks have kind of bad reputations in our industry for being able to close on time and the communication, and had a lot of issues with Bank of America and Navy Federal. So when I have my clients come to me and they want to use their bank or these credit unions, it's like, oh boy, because I have the other side of the transaction to deal with when I have those kind of pre-approvals for these big institutions that we know are a little bit on the slow side and have a bad reputation. It makes our offers more difficult to get accepted. So just picking your brain here, why are they more difficult to work with than a broker tends to be?
Having not worked inside on a bank, I can't speak from firsthand experience, but having been on the downline transaction many times where a major retail bank is on the upline transaction and we're waiting for them, the thing I see is a couple things. Their systems don't tend to be as flexible and easily adaptable as, say, a mortgage banking firm like CMG. If we get in a spot where we've got to move a file, I've got the ability to pick up the phone and ask for a rush and typically get it. Whereas a big bank, they're more system focused and it's very process driven. Now, I'm not saying that they can't accommodate a rush, but when you've got that large of an institution, it tends to be more, you got to fit inside the box in order for things to get done. I think another piece of it is it's just a different mentality there. They will get it done, but they have to go through their process. Whereas a mortgage banking firm like CMG, we're flexible enough and small enough while still being large enough to be able to get things done on a short notice and being able to turn and adapt quickly.
Right. Okay, so the next thing that I thought that we would discuss for the viewers to help them out is just a few do's and don'ts before and during the loan process. So don't go buy furniture or open credit cards, but a lot of people don't know that. And I have seen transactions where, thank goodness, none of mine yet, but like, the buyer quits their job right before closing escrow, that sort of thing. So maybe we'll go over a few do's and don'ts.
Yeah, I think you've hit on the big ones. My goal with any client is to make sure that the scenario that they have that is in place when I complete their pre-approval is the same scenario that goes to underwriting and remains in place through the closing of that loan and that purchase. And the things that you mentioned, no changes to credit. That includes no new inquiries. Inquiries always have to be explained. The classic is, and I've had this happen before, yeah, we wanted to buy new flooring for our house so that we had it all ready and it was in the garage when we're ready to move in. Or we wanted to buy new furniture, or we wanted to buy new appliances, and they went out and they opened credit to buy those things. Well, that's a problem because now we have new credit inquiries, which add new debt, which can affect debt to income ratio. If the debt to income ratio is close and that new account drives it over the limit, they may have just shot themselves in the foot in buying that house. I haven't had this happen, but others have. People went out and bought a new car while they're in escrow. Yeah. Big expenses charged on credit is not a good thing. Changes in employment, that's another big thing. I actually had somebody leave a W-2 job in the middle of a loan to start self-employment. Well, the problem with that is you have to have a 2-year history of a self-employed person in order to use that employment income. That loan died in underwriting. So anything that causes that client scenario to change, whether it has to do with credit, employment, income, you don't go from a full-time permanent position to a part-time per diem position because that changes your income. Anything that changes your assets, you decide that, I had a great opportunity to, buy something that I wanted for a long time and I used my cash, part of my cash to buy that thing. Well, that just could have undermined your purchase because that money that you were going to use for your purchase is now no longer in your bank account. Another big thing is receiving cash into your bank account without proper documentation. You basically want everything that exists as it exists at the beginning of the pre-approval to be the same at the end of the pre-approval. Now, there are exceptions to that, but you always want to talk with your loan officer before anything changes in your credit, your employment, your income, your assets, or anything else that's material to your pre-approval.
That makes sense. And even just from a pure hassle standpoint, because there's a lot of paperwork involved with, that you have to get to the processor to go through the underwriting process, is even even when I've gotten my personal loan, I got a cell phone and that was a credit ding and I had to write a letter of explanation about that. So any little thing that you do that affects your credit, you could end up having to write a letter of explanation about, which can be kind of a hassle. Even, a gym membership, anything that hits your credit can cause that hassle.
Not only letters of explanation, but if there's new credit established, then we've got to go and look at the credit history. We got to contact the creditor, get documentation to explain what that is, show payments. It can be, I won't call it a paperwork nightmare, but I mean, when you're doing a mortgage, there's a lot of documentation to provide. Don't put yourself in a position to have to provide more. Just keep it simple. Don't open new credit. Don't
just wait. Especially the furniture one. That one seems to come up a lot. People, they really want to get furniture before they move in, but just wait.
Yeah. Yep.
That kind of reminded me of another, I have an issue. I had a delay from a loan a transaction that I have in escrow currently, where they didn't transfer the 401k loan funds. They are going to be using their 401k loans as part of their down payment, and that can take like this particular 401k administrator said 2 weeks to transfer the funds over, and the loan officer didn't instruct my buyer early enough because he knew where the funds were coming from to go ahead and start that transfer now. And now we have a little bit of a delay on the close of escrow. So that's another one that I would recommend. What are you seeing as far as, I know it's important with your down payment when you're transferring money around or you're getting a gift, what would you recommend to people on how to organize that? I mean, definitely you want to check with the lender. I I get those kind of questions as well too. Like, oh, I'm getting the gift from my parents, so they're going to be sending it over. And I say, wait, just talk to the lender because I know it has to be tracked. So what are your thoughts about that?
Yeah, a couple things. First of all, if all of your funds for the purchase are coming from your own funds, they've been in your bank account for at least 2 months, and there's no large deposits coming into that account in the last 60 days, you're good to go. But if you're getting funds from other sources, let's say, for example, your case where you're taking funds out of a retirement account, you've got to get in touch with that custodian of the funds well in advance to find out what's the process, how long is it going to take, how are you going to transfer those funds? Are they going to be wired? Are you going to send me a check? I had a case a few years ago where a guy liquidated a large amount, close to $100,000 out of a retirement account to buy a home. And they were paid out in the form of a check. Because that check was so large, when he went to deposit it into the bank, he put it in the bank, and then the bank wouldn't release the funds for 2 weeks because of the large amount of the check. They wanted to see that check clear. That ended up delaying our closing. So you always, if you're going to take money out of a retirement account, you always want to work ahead to say to that custodian of the funds, how do I get these funds out? How long is it going to take? And then you want to find out if it's coming in the form of a check. Is my bank where I'm going to put that in going to hold that check? Because that all plays into the timing of the closing of your purchase. Gift funds, it depends on the loan program. Conventional financing is a little bit easier to move gift funds around. Typically what we need, if the funds are going from the donor, let's say you have parents that are giving you, pick a number, $10,000. If the parents will transfer the funds directly to the escrow account, all we need is a gift letter from donor to escrow account. But if the funds are going to drop into the buyer's account, now we're going to need bank statements. We got to show the funds coming in. We got to show the funds going out. FHA, they're going to want even more documentation from the donor to prove that they have the capacity to give. So here again, you want to put on the radar screen early on with your loan officer what your intent is if you're going to use gift funds. Because what you don't want to do is get down to, you're in underwriting and maybe you've got 2 weeks to closing and say, oh, by the way, I want to use gift funds. Now, the loan officer should have been asking that question long in advance to find out where your funds coming from for your closing. But you don't want to throw a curveball at the last minute that adds time, because the process requires time to get the documentation.
Okay, awesome. Well, thank you so much for sharing all of this information with us today. I am going to link Dale's contact information down below if you are going to be getting a mortgage soon. We send the majority of our clients to Dale. He takes awesome care of them. I will say that Dale has never not gotten a loan done for us of any of the files that we've started. And I think that we have been on time with every single one except for one, and that was escrow's fault. We were 1 day late on one, and he's great with my clients, especially first-time home buyer clients and scenarios. He can help you, like we've got one right now. It's a 1031 exchange. Any kind of complex scenario you have, he'll do the consultation with you, go over your individual situation. And you have taken really great care of my clients. So I highly recommend that you give Dale a call.
Yeah, thanks for having me. It's been great to be here and be a part of your video. You guys are doing an awesome job. You're doing a great job with your clients, and I appreciate the opportunity to be a part of that.
All right. Thank you so much, Dale. Appreciate it. We like bloopers.
You get, start over.
Yeah, there we go. I can't do it. This? Okay. All right, we're getting silly now.
Yeah.